Ladies and gentlemen, welcome once again to another episode of the Think Clinical podcast. My name is Hamza. If you haven't done so already, please remember to subscribe, like, and share our page. This is going to be another exciting episode and a continuation from our last week's episode on financial statements. And just so that everybody is updated on where we are, last week we spoke about what financial statements are, which are just reports that summarize your activities and your financial performance over a period of time. And we presented these in three different ways. In three different forms. They usually come as either balance sheets, as income statements, or cash flow statements. So last week we went through what a balance sheet is, basically how it looks like, just the basics of it, what you need to know on it, what the principles are behind it. And today we'll do the same with income statements and cash flow statements. At the end of this, when you take any of the statements that you talk about on your in evaluating the financial health of your company, you should be able to actually have a basic understanding of what each item means and what basically you should be looking for. So if you want to see how much profits you make, you know where to look. If you want to see where your cash is, how your cash flow is looking like, you know where to look. When you want to see what you owe and what you own, all those things, you know where to look forward at exactly the same time. When you're looking at this, you actually have a very good understanding of what you're looking at, not just having people feed you with what they think it should be. But these are very basic overviews of these statements, and today we'll talk about income statements, which basically summarize your business's revenue and expenses over a period of time. So this is over a period of time. Balance sheets were giving a snapshot of your company's financial health at a point in time. But these are going to give you, the income statements will give you an overview of how much your company's revenues, that's how much your company is making from its core operating services, and how much it is spending. So you are trying to look at what you're making against what you're spending over a period of time. So there are three main things that you will have to look at on your income statements, or as people will call it, your P&Ls, your profit and loss statements. And that's going to be first of all, your revenue, your expenses, and your profits or loss. So if your revenue is obviously you are making more than you are spending, you're actually going to be making a profit. If you are making less than you are spending, you're going to be making a loss. So that's the basic principle. But then profitability is key to an income statement. So when you look at that income statement, the key to that statement is profitability. So it does not really translate into cash flow. That's why we look at cash flow statements separately. But when we come to looking at cash flow statements, we'll also look at the different terms of accounting and how that translates, how profitability or how these statements can be translated or related to each other depending on your type of accounting or how you capture your expenses and your revenue. So let's expand what an income statement looks like. First of all, you see your operating revenue or your revenue, which is income that you generate from just doing your business. Okay, that's one of the first ads. So you see a figure attached to that. So let's say you made $1,000 out of your revenue. That's what you are making from your business, right? The second thing that you're going to be talking about is going to be your direct operating cost. So this is your cost of sales. This is the cost involved directly, items that you use directly in providing the service or the goods that you provide to give you the revenue. So those are going to be your direct operating costs. Now when you look at the items or the items that you use directly to generate revenue or in your day-to-day processes. So let's say you are a hospital business and every day you buy medical supplies, you buy medication, you pay your clinicians, you pay for power because you need power to work. Those are direct cost that you use to translate to business. So when you buy consumables, you buy medical supplies, you use those supplies to provide direct service. It's directly related to your core business. So that's the direct operating cost. And so the third line after this, so you have your revenue, you have your direct operating cost, which is your cost of sales. The difference between those two should give you a gross profit, which means that at that time you still haven't captured your overhead. You haven't looked at all the different things that also could generate revenue. That's your indirect operating cost, like advertising, like giving out sales commissions. You have not translated all those indirect costs. So then after your gross profit, the next stage you come to is looking at your indirect costs. How much are you spending on advertising? If you are incentivizing clinicians or your teams to be able to produce or create more revenue, that also drives sales, it drives revenue. So those are indirect costs that you are incurring, but they are also feeding into your revenue. So you look at your revenue, look at your direct cost. The difference between those is going to be a gross profit. Look at your overhead now. The difference between your overhead, which is your indirect operating cost, and your gross profit, which was already a difference between your direct cost and your operating cost, is now going to be your operating profit or your operating loss, depending on how much you spent on all these costs. So the direct and indirect costs would actually reflect whether you are in a position of making profits or a position of making losses. Now you go on to your non-operating costs. Now these are not related to the business in any how, and you do not contribute to the revenue in any way. So you are going to look at your interest expenses. You're going to be looking at your taxes, all these things. So when you look at your operating, let me take you back a bit. You will see in some income statements that your operating profit is captured as EBIT, which is EBIT. That's earnings before interest and taxes, because after your operating costs, you're now going to be looking at all the indirect non-operating costs, which comes in the form of interest and then taxes. So your operating profit is also equal to your earnings before interest and taxes. So you might see EBIT instead of operating costs, is the same thing. And now after you take out all the indirect non-operating costs, you are down to your bottom line, which is your net profit, and which is what you want to look at. And that's one of the keys to looking at an income statement. So again, you look at your operating revenue or revenue, look at direct operating cost, which is your cost of sales. The difference between those two is going to be your gross profit. Now beyond that, you look at other items. So your direct operating costs are things that you're using directly in providing the service or the goods that you want. And then you move beyond that, and then you have your indirect ones, which are also generating revenue, but they are not directly related to the core business. And then which are like advertising. The difference between the indirect cost now and your gross profit now brings you down to your operating profit or your EBIT. Now you take out your interest and your taxes, and then get your bottom line, which is your net profit or your net loss. That is how basically it looks. So when you're reading the income statement, that is how you systematically go through it to be able to appreciate where you are with the different things. Now we move on to the cash flow statement, and I'm going to be explaining the here. The cash flow statement, it shows the business, it shows how much cash is coming in and how much cash is going out. So it's going to tell you where your money is coming from, what is coming in, and where your money is going. So you're able to, and this is one of the most important income financial statements you have as a business. Most businesses do not have cash flow statements, so they do not know where their cash is. They don't know where their cash is going. They don't know what is coming in, and that is not a very good practice. Now, when I was just going to talk about this, when you talk about doing cash flow statements, now two things come to mind. Are you doing more of a cash accounting method? Are you keeping your records via a cash accounting method, which is usually used by small businesses? Or you are doing this by the accrual accounting method? Let me explain. When you talk about cash accounting method, mostly some businesses only record income when they receive cash. So when a vendor pays them in cash, that's when they record revenue. And when they pay out any form of expense, that's when they record expenses. Now that means that most of the time when you have such a direct relationship, then your income statement is equal to your cash flow statement, because you only record revenue when you receive it and you record expenses when you actually pay it out. But assuming you paid or you received money now for a service that you did, let's say last year, in the last fiscal year or the last accounting period, it means that you are recording money that wasn't earned within the period of the reporting. And so it really does not give a true reflection of how your financial health has been like. So this, even though it's used widely by a lot of small companies because it's easy, it's usually difficult to translate this and actually to have a conversation with investors, because you really don't appreciate how your money comes in and out. You don't, the financial health of your company at a specific point in time is not accurate, because you're not representing it in the most accurate way. So most companies use what we call accrual accounting, which is if you earn any revenue now, even without receiving cash, you record it. If you pay out or if you incur any expense within the period, you record it, even if you haven't paid it out yet. So you actually record revenue when it's earned, and then you record expenses when it's paid out. When it's incurred, not paid out. So this is basically, so that is when cash flow statements become important, because when you're using cash accounting, most of the time your cash flow statements are the same as your income statement, so you don't really need much there. Now, looking at these things, there are three items that you look at on your cash flow statement. You're going to look at cash that is flowing from your operating activities, and these are regular business activities. These are the main revenue generating activities that you have in your organization. You're also going to have cash from investing activities, which is going to be outside the core business activities of your business. Maybe you are selling an asset or something else that is bringing you in money, so that's going to be cash from investing activities. And then you look at cash flow from financing activities, which comes in the form of loans that you may take from the bank, or equity from partners injecting their own money, capital contributions that partners will inject back into the business to make it profitable. So these are the three main things you're going to see on a cash flow statement, and each of them you're going to see. Positive means that the cash is coming in from that activity, negative means that it's going out. So you're going to see items like income from goods sold, which is going to be like revenue, like money coming in. It's going to be like expenses paid out within that section, which is going to be like money being out. But those are all going to fall under cash from operating activities. And the same thing for cash flow from investing activities and cash flow from financing activities. So to wrap up this, I would like to emphasize, and as I said, these are very basic outlines of what you need to see or understand or interpret from when you're looking at these statements. The big part of this, and to close this session, would be, please remember that cash and profits are different activities. Those are different things. Cash is not equal to your profit, because your profit is just a financial benefit that the business gains when the revenue is bigger than the expenses. So when your revenue is more than your expenses, that's what we call profits, but that's not equal to your cash. So anytime you have a business, you need all these three financial statements to be able to get a full picture of, again, from your balance sheet, what you own against what you owe. From your income statement, knowing how much you're making from your business against how much you're spending, and whether or not you're spending more than you're making. And then from your cash flow statement, knowing what is bringing in cash, what is causing inflow of cash, and what is causing outflow of cash. So if you understand these basic principles, the conversation becomes easier, because then you can step it up and start looking at all these different components and what you can do to get around them. Ladies and gentlemen, this has been another episode of the Think Clinical podcast. I hope you enjoyed it. Please leave your comments in the comment section. We are always happy to engage with you, and have a beautiful, beautiful week. Thank you.